Welcome to Market Watch Daily. I'm TMI, bringing you the latest insights into global finance and market movements. Today, we're breaking down the early morning flash crash that erased over $600 billion from the S&P 500 futures market only for it to bounce back minutes later. What caused this sudden volatility? Let's dig in. At exactly 4:40 am Eastern Time, the S&P 500 futures experienced a steep drop. In a matter of minutes, the futures were down over 1.4%, equivalent to roughly $600 billion in market value. But just as fast as they fell, they rebounded by 6:20 am. That's less than 2 hours of complete chaos. So what happened? Chapter 1. The anatomy of a flash crash. Flash crashes are rapid, deep market sell-offs that typically reverse within minutes or hours. They're often triggered by a mix of factors: automated trading algorithms, lack of liquidity, geopolitical events, or sudden economic data releases. Chapter 2. Likely triggers. Let's look at what may have caused this crash. 1. Algorithmic trading. The speed of this drop strongly suggests that algorithmic and high-frequency traders were involved. These systems can act on headlines or pricing anomalies in milliseconds, causing ripple effects across markets. 2. Low pre-market liquidity. Before the opening bell, liquidity is thinner. That makes the market more vulnerable to large trades or sudden sell-offs. It's like throwing a rock in a still pond, big splash, fast ripple. 3. Global economic concerns. Market watchers pointed to the continued uncertainty over trade policy, especially President Trump's renewed tariff threats. Additionally, the Swiss National Bank made headlines with a surprise interest rate cut, signaling global economic fragility. 4. Geopolitical tension. Reports surfaced overnight of Israeli airstrikes in Gaza and a large explosion at a Russian airfield, possibly from a Ukrainian drone. Those stories added to global risk-off sentiment. Chapter 3. Why the market rebounded. Even though the futures plummeted, markets corrected quickly. Why? Traders likely saw this as an overreaction, a temporary shock amplified by algorithms and low liquidity. Bargain hunters stepped in fast. Also, with no underlying economic data to justify the move, investors may have shrugged it off as an anomaly. Flash crashes aren't new. In 2010, a massive drop in the Dow Jones was caused by a single large trade that cascaded across automated systems. More recently, smaller flash crashes have occurred in futures and crypto markets, often during off-hours trading. Chapter 5. Takeaways for investors. This morning's flash crash is a reminder of the modern market sensitivity. The mix of algorithmic trading, thin liquidity, and geopolitical risk makes for a fragile environment. Investors should use stop losses judiciously. Avoid overreacting to short-term volatility. Stay informed about global events and macro trends. Conclusion. The $600 billion flash crash was dramatic, but it wasn't lasting. It underscores how quickly sentiment can shift and how important it is to have a steady, informed approach to markets. We'll continue to monitor for any lasting effects as markets digest what happened. Stay tuned to Market Watch Daily for more breakdowns of market-moving events, financial trends, and economic developments worldwide.